In this video, I'm going to review two Canadian covered call ETFs, both yielding over 10% annually, paying monthly dividends. The first one here is ticker HDIF, the Harvest Diversified Monthly Income ETF. This stock here, as you can see, up 1.5% on the day. In the last year, it's been about flat. Over the last 5 years, it's actually down. You'll see that covered call ETFs don't necessarily track the broader market, as they sometimes leave some of the growth on the table for the dividends that they're paying out today. Generally speaking, right now paying about a 10.1% yield. If you got that 10% yield, even if you didn't reinvest it for compounded returns, that would be about 50% back over the last 5 years. So the total return would probably be something closer to 37%, which is about a 7.5% rate of return on a net basis. This one here actually owns a bunch of the other Harvest covered call ETFs, and they just kind of bundle it around to diversify the risk. I think they also put 20 or 30% leverage to boost the yield. So that means that their covered call ETF may organically have 7.5, 8% dividend yield. They'll borrow money at 3, 4, 5%. And buy more into those equities in that covered call strategy to enhance the yield up to this 10% level. So it is some risk associated from the leverage. Obviously, the higher the leverage position of a covered call ETF, the riskier it is. But that's just how you get the 10% yield. And overall, over the last number of years, while it hasn't necessarily outperformed the market, it has been able to provide a steady source of cash flow to investors. The second one here is a Canadian company in terms of where it's listed on the TSX, but it's actually buying covered calls on the S&P 500. So you're getting some underlying US equity exposure. You can see here in the last year performing a bit better, about 3.5% up, similar dividend yield at about 10.1%. I imagine they kind of implement a similar strategy. It's not necessarily buying all the funds that Global X has, like the HDIF portfolio, but it is buying the S&P 500. So that's 500 US companies that are kind of vetted in the S&P that you're getting some underlying exposure to there. If you like this kind of content, be sure to subscribe to the channel, like this